everybody. Frank Ray here with the National Real Estate Post, NRP Daily, of course, with Barry Habib. As you can see, before we get started, Barry, just want all the loan originators to know out there, if any of you are feeling like, and this goes right with our show today, if any of you are feeling like, man, these refis might be drying up on me here pretty quick, and I got to get back to some realtor business. I gotta look back at some relationships. That's what Listing Booster is designed for relationships. It was built and made to get new relationships and build relationships. And that's what it's all about. If you're interested in taking a look, just click the banner you see on your screen right below the video. One of our team will show you the goods, see if you like it. So how's it going, my friend?
Well, I must say you look quite dapper in your STEAM team uniform there. That's great. And it's all about the STEAM, brother.
Well, STEAM is really powerful. It moves things, and that's what the STEAM team's all about. It's an elite group of people that, high producing people, that understand the power of STEAM.
There you go.
Yeah. So anyhow, here's what I want to talk about today. So in the news, we see Fannie Mae saying in 2021, rates are going to stay under 3. Okay. But we see MBA saying in 2021, we're going to see rates go over 3. What does Barry think?
So yeah, the MBA was very draconian. In fact, much higher they thought rates would be going, but I think they're both correct in a way, because I think that we're going to be in a range. And it's important too, because there's a really important threshold, I think, at around 3.25% that will slow refinances by about 50% of the volume that you're experiencing right now. So it's a good time right now. There's going to be headwinds in 2021. One could be if interest rates do move up from their present levels to about 3.25%, you'd see about half the refinance business dry up, unless you're smart and you're doing debt consolidation, in which case you will be able to really continue to do very, very well. A debt consolidation is very critical because, number one, you're helping the customer. You're doing some wonderful things for them by shortening their term, paying off their debts, putting money away for their future. But what you're also doing is you're increasing your loan size significantly. So you're able to kind of weather a decrease in transaction volume by increasing loan amount. So you're going to mitigate the loss to some extent. Now, if rates go above 3.25%, why is that an important threshold? Because more than half of all mortgages outstanding today are below 4%. The typical incentive to want to do a refinance is about 0.75%. So when you factor that in, 3.25% puts people right on the borderline of saying, hey, if it's above 3.25%, I don't know if it makes sense for me to save 0.5% or whatever it is. So once you get to 3.25% on rates, it's going to make a big change. And then, at that point, to go to real estate agents, if you don't start seeing the future before it becomes obvious, really smart people and really successful people, they don't wait till it's too late. Because here's the mentality of most mortgage originators. Hey, it's great. I'm happy now. I want to enjoy myself now. It's good. And I get that.
Sure.
But to think that this is going to last forever in this particular state, that's just not going to happen. So when we look at this opportunity that we have, sure, we want to maximize it. And that's the first thing we should be doing. But then to not be working on a future game plan and being sharp on conversion of conversations by being smarter, by understanding the markets, by being able to understand debt consolidation, and by working with real estate agents using things like Listing Booster. These are the types of things that you have to do today, because when interest rates invariably at some point in time cross over this level, the average originator is going to be like, oh, things are great still, it's okay. I could use this little bit of a break. And then the money keeps flowing in for the next 60 days anyway, so you don't feel it. But then one day you say, wow, I'm not really that busy. And my next check may not be what I've been accustomed to. Yeah. And then to start trying to get that inertia to pick up the steam to go forward from there, it's very difficult unless you continuously are doing things. So as far as rates go, to answer your question with that preface, is that we have to watch inflation. And yesterday we got numbers, exactly what we were talking about. We said, that supply chain disruption is going to cause an inflation spike. And we're starting to see that that's what caused a little bit of turbulence in the bond market last couple of days. Okay. We saw rates rise. But unless we get a little bit of calmness on the inflation front, we're going to continue to see a little bit of a nudge higher in rates or some persistence in allowing them to go much lower. And we don't need too much to get them up above 3%. But once the masks come off, once we get the vaccines and we get the supply chain back, I think you're in for a lot lower rates. We just got Janet Yellen as the Treasury Secretary. Right. She wants to buy long-term bonds. She's going to bless everything that the Fed wants to do, where Mnuchin would butt heads with Powell. Yeah. Janet Yellen, you know, she didn't find a spending deal she doesn't love. So she's on a shop, you know, she wants to spend. Now, while that might not be good in the long term for us in the mortgage industry, you have somebody who's now the Treasury Secretary, who, by the way, her signature will be on all the future printed bills out there. Your $100 bill, $1 would be her signature on it. It will be easier for the Fed to buy longer term maturities, to stay active in the market, and to do those things that overall can help interest rates come down, at least in the short term. So it's going to be a good ride, I think, for a while.
So here's speaking of the vaccine and everything you just said. So for me, you mentioned that if we get a vaccine soon, that this could help us rate wise. And I'm thinking to myself the opposite. I was going, I would think a vaccine would, take care of some problems that would help get people back to work, get businesses back to open. So maybe investors want to go into stocks, instead of bonds with a vaccine that comes out, and therefore, out of bonds into stocks, rates would go up. But that's not what you're thinking.
Well, what I'm saying is that the biggest driver of interest rates is inflation.
Yeah.
And right now we're seeing a little bit of an inflation spike because there's just a lot more demand than we are seeing come back in the ability for the supply chain to meet that, due to the fact that a lot of companies have closed, a lot of people are still out of work. Remember, we lost 20 million jobs from the pandemic, only 10 million have come back. So when you have 10 million more people out of work, that will cause some supply chain disruption. And look, for all of us, how much of an inconvenience has, trying to be safe for, transmission of COVID, the things that we're limited to do this. You can't do that. The inconveniences that we're circumventing in many cases, but overall, it definitely has some disruption in the supply chain, and that disruption causes prices to rise. That rise in prices causes interest rates to be nudged a little bit higher. When you have people come back to work, both by feeling comfortable to do so and having the ability to do so, then the supply chain comes back to meet demand, and then inflation will come back down.
Got it. Okay, see, there you go. That's why we have you on the show.
Thanks, man.
Well, great.
No, it's a great question, because we're at such a good level of interest rates. So listen, if you're out there, you're enjoying yourself, you're having a good time, great. But don't stop thinking about tomorrow, as the song goes, okay? Because it's going to change in the future. The one thing you can always depend on in life is it's ever changing. Totally. And if you really want to be a great CEO of your business, it's your job to look down the road and see what could happen and start preparing for it today. Now's the time for you to do that. Get the resources available to you. Just go and do some things for marketing. Maybe get an assistant now while you can afford to do so. Do the things that you should be able to do right now.
Great stuff.
And listening booster, for goodness sakes, too.
Yeah, and MBS Highway, obviously, especially now with the consumer is so dialed into interest rates, mortgage rates, and they're sensitive to these things. So you guys, by having MBS Highway, you become that advisor to them on what's going on, so you can make intelligent decisions and help them. So I'll put MBS Highway's link down below. Of course, we got Listing Booster down below as well. But overall, great information, great show. Thank you.
Thank you, brother. Thank you, brother. Full steam ahead.
Full steam ahead, man. That's the way it is. I'm on the Steam team, man. So it's all good. So you all have a great day. Leave us your comments down below. Forward, share, and subscribe, and get our mobile app by doing this. See you, Barry.
Thanks, man.
Download the National Real Estate Post mobile app today. Available on Apple Store and Google Play. Just search National Real Estate Post.